Brent crude prices are down about 23% since this year's peak of $123 per barrel as economists predict recession in developed economies and muted demand globally. However, to bolster prices, the Organization of the Petroleum Exporting Countries, or OPEC, and its allies on Monday decided to cut production for October by 100,000 barrels per day. The move, however, didn't surprise domestic market watchers who remain unperturbed by the minuscule cut. According to VK Vijaykumar of Geojit Financial Services, OPEC Plus' decision to cut oil output by 100,000 barrels a day is only 0.1% of global demand. Therefore, it is grossly inadequate to move the needle on oil prices. Brent crude prices had jumped 4% after the announcement, but retreated around 1% later. That said, analysts caution against further cut in supply, which may impact India in the long term.
However, the key thing to take away from the decision is a signal from OPEC Plus that they stand ready to cut output to support prices in the event of any sharp weakness in crude price, given the concerns around Chinese economy and the potential recession in Europe and US. So I think this decision will help to put a floor to crude and support prices given the macro related uncertainty. Obviously, the geopolitical development around Russia and Europe in terms of energy supply will be another key factor which will determine where crude is headed. From Indian market perspective, obviously high crude price is negative for India given we are more than 80% dependent on imports for crude. So from that perspective, yeah, this is not very positive from Indian market perspective.
Meanwhile, another crisis is looming in the energy markets. Spot liquefied natural gas prices in Asia touched a record high of $70 per MMBTU last week, a threefold increase in 3 months. This comes after Russia's state-owned energy giant Gazprom shut down the Nord Stream 1 pipeline indefinitely due to an oil leak in a turbine. With ballooning global prices, analysts see downside risks to margin of gas distributors in the near term.
On the gas consuming side, it is going to create a lot of pressure as far as EBITDA margins are concerned. In the short term, given that they have reached record high levels of almost $70 as of last week and are expected to, continue to sort of, remain very high. We do expect that particularly for the CGDs, there could be a very sharp drop off in terms of the gross margins and EBITDA margins overall over second quarter and third quarter. The other thing that it does is if these prices continue to persist, even the domestic gas prices, both for October and April, will also see a significant uptick, which is also a negative.
ICICI Securities expects EBITDA per standard cubic meter for Indraprastha gas and Mahanagar gas to reduce by 20 to 38%, but increase by 35% for Gujarat Gas in FY23. For GAIL, Gujarat State Petronet and Petronet LNG, lower volumes and or higher costs can reduce EBITDA by 6 to 20%. Overall, the near-term outlook for listed players linked to oil and gas sector remains uncertain. Analysts suggest only long-term investors stay put in these stocks. On Wednesday, global cues and stock-specific action will guide the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.